Warren Buffett's Ground Rules, book by Jeremy C. Miller. Chapter 2. How to really get rich from your investments. In the previous chapter, we established that Warren Buffett believes in a slow and steady wins the race style of investing. But now we'll take a closer look at what that means. If we understand that stocks or shares represent a small portion of a business, then we can understand that a stock's price represents the financial success of that company. This means that many people want to buy stocks in big, established companies like Google or Facebook. Because these companies are doing well financially, we assume that buying stocks in these companies will bring us a lot of money. However, Buffett understands a little-known trick. If you buy stocks in small companies that are not very popular yet, you can expect a sizable profit when that company eventually takes off and its share price skyrockets. To put this into context, just imagine investing in Facebook before it was Facebook. Today, the social media network is an international sensation. But before it became the Facebook we know and love today, it was a little social media platform, started in one guy's college dorm. When it first started out, Facebook might not have looked like a very big deal to prospective investors. But the investors who bought shares in Facebook at that stage were later rewarded by its spectacular growth. And the same could be true for you if you invest in an undervalued business. This might mean that you're playing the long game with your investments, but Warren Buffett has first-hand experience with the benefits of the long game. He's learned that you should stop worrying about when your stocks will become profitable. Avoid making rushed decisions or focusing on when your stock's value will rise. Instead, know your stocks, know your market, and wait. Trust that the market will do what you know it should do, and then wait for it to do its thing. It might take longer than you want, and the value of your stocks might fall at times. But don't panic and sell your shares prematurely. Many people make this mistake because they think investing in the stock market means making split-second decisions. But remember that slow and steady wins the race. If you've made a smart investment, you'll see a return on that investment. It just might take a little while. Buffett also observes that when you play the long game, you receive compound interest on your investment. Financial analyst Jason Fernando provides a simple explanation of compound interest that asserts compound interest, or compounding interest, is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. Thought to have originated in 17th century Italy, compound interest can be thought of as interest on interest, and will make a sum grow at a faster rate than simple interest, which is calculated only on the principal amount. The rate at which compound interest accrues depends on the frequency of compounding, such that the higher the number of compounding periods, the greater the compound interest. Thus, the amount of compound interest accrued on $100 compounded at 10% annually will be lower than that on $100 compounded at 5% semi-annually over the same time period. Since the interest-on-interest effect can generate increasingly positive returns based on the initial principal amount, it has sometimes been referred to as the miracle of compound interest. Fernando also observes that if considering the principle of compound interest in practical application can help us understand more about the return we can realistically see from investments. For example, he writes that compound interest can significantly boost investment returns over the long term. While a $100,000 deposit that receives 5% simple annual interest would earn $50,000 in total interest over 10 years, the annual compound interest of 5% on $10,000 would amount to $62,889.46 over the same period, if the compounding period were instead paid monthly over the same 10-year period at 5% compound interest. The total interest would instead grow to $64,700.95. Put simply, compound interest helps your investment to get bigger over a shorter amount of time. If you follow these strategies, we can't guarantee that you'll become a billionaire like Warren Buffett. That's determined by you, your investments, and the choices you make. But if you follow Warren Buffett's top tips, you will definitely make smarter investments that will likely lead to a profitable return.